Today I'm going to talk to you about offset accounts, what they are, how they work, and I'll go through an example, the benefits of an offset account, and a couple of things you need to know about them as well. My name is Daniel Thompson. I'm a financial advisor and the founder of New Era Financial Planning. So let's jump into it. This will be a nice short video. In terms of an offset account, what they are essentially is a bank account. So it is a separate bank account that's attached to a mortgage or home loan. With that bank account, the idea with an offset account is you don't accrue interest, or you don't get interest on that bank account like you would in a savings account. What you do is you offset the interest on the home loan that's attached to based on the amount of money that's in that offset account. So as an example with how it works, say you've got a $500,000 mortgage and you have $100,000 in an offset account. That offset account won't make interest. So as a sort of comparison, if you had that $100,000 in a high interest bank account earning 5%, that would give you $5,000 a year, for example. It's very simple, 5% on that. In an offset account, that $100,000 won't make you that interest. It will offset the interest on that $500,000 mortgage. So if the $500,000 mortgage has a 6% interest rate, the interest basically accrued and charged by the bank, well, the bank will only charge interest on $400,000 of that loan because you've got $100,000 in the offset. So the benefit of that is there's really two major ones. The first is the interest that you're saving on the mortgage is usually almost always higher than the interest you will get on a bank account, even a high interest bank account. So at the moment, for example, if mortgage interest rates are around 6%, the high interest bank accounts savings rates might be 5%. So your $100,000, if it's in a bank account, earning 5% makes you $5,000 a year. If it's offsetting the mortgage at 6%, you're saving $6,000 a year in interest repayments. So right there, you've got a difference, not a huge one, but that's a benefit in itself. The second big part comes when you combine that with the tax effects and impacts. So that $5,000, if you had that $100,000 in a bank account, that $5,000 that earned is income, classed as income and taxable for you. So you might pay 30%, for example, or even more on that in terms of tax. So of that 5,000, 1,500, let's call it as an example, maybe the tax paid, and you end up with, at the end of the financial year, you end up with $3,500 of that 5,000. In terms of the offset account, the 6% that it saves, that $6,000 interest saving, is not taxable. It's not an income, so there's no tax implication. So you get the full benefit of that $6,000. So when you compare the after-tax effects or impacts, you're saving $6,000 in interest from an offset account versus making, let's call it $3,500 in this example, after tax in income if you had that money sitting in a high interest account. So that's where we see it's almost double the benefits, and the benefit of that offset account is quite large. Now, the things you need to know, there's a couple of things with an offset account. One is most banks do charge a little bit more in terms of interest rate and or a monthly fee to have a loan with a linked offset account. It's usually not huge. It might be $10 or $15 a month and or 0.1 or 0.2% extra in terms of interest. So if a basic simple interest mortgage account has an interest rate of 6%, you might pay 6.1 or 6.15% for one with an offset. So we tend to find that when we do the numbers, you probably want about or at least $20,000 to put into an offset account to make it worthwhile when factoring in those fees. So once you start to get above that, it becomes more beneficial, Below that, it's sort of not as beneficial once you factor in the fees. And that's what we find the break-even point tends to be as a general idea. The other thing is, and a lot of people sort of get a bit confused with this, having an offset account won't reduce your mortgage repayments. So that, say, $6,000 a year in interest savings won't reduce the repayments by $6,000 a year. What happens is the repayments, let's say you've got the $500,000 mortgage, the repayments are the same whether you've got an offset account or not. Whatever the repayments are, let's say they're $2,500 a month, they will remain the same. So having an offset account doesn't help from, let's call it a cash flow perspective, to help reduce the the mortgage repayments, or even the interest rate. It doesn't reduce the interest rate itself. What it does is, of that $2,500, person A that has no offset account, $500,000 and $2,500 a month in repayments. For example, let's say $500 a month of that goes towards paying what we call the principal, which is actually the balance of the loan down. So month one, you pay $500, so you have $499,500. The rest will go to interest, which is to the bank. Month two, same again, $2,500. $500 will go to the loan, so there'll be then $499,000, let's call it, owing, and the rest goes to the bank. So that's sort of the standard way. With an offset account, the same $2,500 repayments will be made, but the bank will only charge interest on $400,000 of that loan. So this, as we went through, you've got a $500,000 mortgage, $100,000 offset, and the interest charge is only on $400,000. So of that $2,500, as an example, $1,000 a month might go towards the principal rather than the initial $500 or the previous $500, and the other $1,500 goes to the bank for the interest component. So as you can see, it's a good benefit there, and over time, that's where it really does add up to, meaning you pay the mortgage down a lot quicker. So if $1,000 a month is going off the balance rather than $500 a month, as an example, you can quickly see that it's going to start to really reduce that balance, not in the first month or two, but definitely over a number of years. And we tend to see that you can cut a 30-year mortgage down to sort of 20 to 25 quite easily with that. And on top of that, which we'll talk about in a separate video, you can make extra payments and do some other things. But this is that's the benefit of an offset account. So as well, it doesn't reduce the repayment itself, doesn't reduce the interest rate. It reduces the amount of interest that the bank charges, because you've got that money sitting in an offset account, offsetting the mortgage. And it then means the big benefit is that interest that you're saving, it's not money in your pocket, it's the repayments will pay the mortgage down quicker. And so that's, say it's $6,000 in that first year of interest saving, that'll mean that an extra $6,000 in the mortgage repayment. And then each year, that sort of compounds in a way that means you end up paying it off, even without any extra repayments, in this case, quite a bit quicker, and saving many years and dollars off the mortgage in terms of interest repayments. So when you hear people say having an offset account can shave years or a lot of tens of thousands of dollars off the mortgage, that's what it means. It's the interest saving and the quicker sort of principal, paying it off quicker, that then shaves off 5-7 years off the mortgage as well. If you have any questions about it, reach out. I'll pop all the details below. We'll do a separate video. There's offshoots of this as well. There's also a redraw, which is different to an offset account, which I'll explain in a different video. Very similar, but different concept. But if there's anything else you need, feel free to reach out anytime.